Every trader has faced this moment. You open a position, you carefully place your stop loss just below support or above resistance, and you feel safe. But then, almost like magic, the market spikes exactly to your stop, takes you out of the trade, and then immediately goes in the direction you expected. It feels unfair. It feels like the market is hunting you personally. But the reality is even bigger. This is not bad luck. It is not coincidence. This is liquidity manipulation. The financial markets are not fair. They are not neutral. They are controlled, influenced, and moved by institutions, the big players. Banks, hedge funds, prop firms, and massive funds are the wolves in the market. And retail traders, people like you and me, are the sheep. Most of us don't realize it, and that's why the majority of traders lose. So let's break it down. Who actually moves the price? It's not you, it's not me, it's not the millions of small retail traders combined. Our accounts are tiny in comparison. The real movements, the large waves in the market, are created by institutional players. But these institutions have a problem. Imagine you want to buy $500 million worth of a currency pair. If you just hit the buy button, the price would explode upwards and you'd get a terrible entry. You'd literally move the market against yourself. So what do institutions need? They need liquidity. They need someone to take the opposite side of their trade. If they want to buy, they need sellers. If they want to sell, they need buyers. And where can they find these huge pockets of liquidity? In the stop losses of retail traders. Liquidity in the simplest terms is just orders waiting in the market. It's the fuel that allows price to move, and the biggest pools of liquidity are located exactly where retail traders are trained to put their stops. Above obvious swing highs, you'll find the stop losses of short sellers. That's what ICT traders call buy-side liquidity. Below obvious swing lows, you'll find the stop losses of long traders. That's sell-side liquidity. Think about it. Every beginner book says put your stop just below support or just above resistance. Every course teaches the same thing, and that creates a trap. Because institutions know this. They know that right below that support is a pile of stop loss orders. They know that right above resistance is a pile of stop loss orders. So where do you think the market is drawn to? To those levels. Because that's where the fuel is. It's like a magnet. Price is constantly reaching for liquidity, and once it collects that liquidity, only then does it move in the real direction. Let me give you an example. Imagine the market is moving upward and forms a clear resistance level. Retail traders start shorting because it looks like a top. They put their stop losses just above that level. Now institutions step in. They push price just a little bit higher, triggering all those stop losses. Retail shorts are wiped out. Their orders turn into buy orders. And that gives the institutions exactly what they wanted: liquidity to sell into. After they collect that liquidity, what happens? The market reverses and drops exactly the way retail expected from the beginning, but retail is no longer in the game. They were stopped out. That's a stop hunt. That's liquidity manipulation. And it happens every single day. The same scenario plays out on the downside. Like price approaches a clear support, retail traders buy. They place their stops just below the low. Institutions push the price lower, hit those stops, collect liquidity, and then drive price back up. This isn't random. It's not bad luck. It's the design of the game. Now let's go deeper. Why do institutions do this? Because they have no choice. To move hundreds of millions, they need an ocean of orders, and the easiest way to find that ocean is to target retail stop losses. Every obvious high and low is like a pool of money waiting to be taken. It's important to understand. Institutions don't hate you. They're not trying to destroy you personally. They're simply executing their business model. But in doing so, they wipe out the majority of retail traders who keep repeating the same mistakes, trading breakouts blindly, putting stops in obvious places, chasing the market without understanding liquidity. This is why around 90% of retail traders lose consistently. They are trading against the very structure of the market. So what can you do? How do you stop being the victim of this manipulation and start using it to your advantage? Step 1. Look for liquidity. Identify the obvious highs and lows on your chart. Don't think of them as places to enter. Think of them as targets for the market. Step 2. Wait for the grab. Be patient. Don't enter right away. Watch as the market runs those highs or lows, collects the stops, and manipulates retail traders out of their positions. Step 3. Enter after confirmation. Like once the liquidity has been taken, the market often shifts structure. You'll see a break of market structure, you'll see an order block forming, or you'll notice a fair value gap. That's your chance. That's when you align yourself with the institutions instead of against them. This approach requires discipline, it requires waiting, but it flips the game. Instead of being the sheep, you start moving like the wolf. Let's recap with a few practical patterns. Pattern 1, the false breakout. Price runs above resistance, takes liquidity, then drops. Pattern 2, the liquidity sweep. Price dips below a low, wipes out stop losses, then quickly recovers and continues upward. Pattern 3, the double top or double bottom trap. Retail thinks these are strong reversal points. In reality, they're magnets for liquidity. Price almost always runs through them before making the real move. When you start looking at charts through this lens, you'll see manipulation everywhere, and suddenly it all makes sense. You'll realize why your stop losses always got hit. You'll see why breakouts so often fail. You'll understand that the market isn't random, it's engineered. So here's the truth, the market is manipulated, and that's not a conspiracy theory, it's simply how institutions operate. But this is not bad news, in fact it's an opportunity, because once you understand liquidity and a manipulation, you can stop fighting the tide, you can ride with it. Liquidity is the fuel of the market. Institutions need it to fill their massive orders. If you don't know this, you'll always be trapped. If you do know this, you can finally start trading on the winning side. So next time you see a clean support or resistance level, don't just ask yourself, will it break or hold? Instead ask, where is the liquidity and who needs to take it? When you shift your perspective from being hunted to hunting with the institutions, trading stops being random and starts making sense.